Hey guys, Robbie. Just wanted to do a quick video. I've been watching a couple videos with Robert Kiyosaki, Rich Dad, Poor Dad, and he has a lot of great advice. Reading his book when I think I read it when I was like 24, 25, Rich Dad, Poor Dad, got pretty much every other book he's made. He has some really in-depth real estate books, but there's a piece of advice that him and some others like Grant Cardone give in regards to real estate that is technically correct. It's correct, but it's not really going to help the beginners in real estate or people that don't have massive wealth already built up. And that's the fact that they're telling you to buy large assets and projects. So we're talking like really large apartment buildings, like 32 units and above, which is great. I mean, those are definitely fantastic investments if you get it in the right area. But the average person that's making 100K or saved up, a little bit of money can't really jump into that unless they either give it to someone like Grant Cardone or some other third party that's doing bigger deals, and then they just take a piece of their return. The problem with that is they don't get to fully leverage their capital, so it's going to hinder their actual return on investment. I'm going to do another video about breaking down a potential real estate investment, but this video I just want to compare a few different asset classes and why I think getting into residential multifamily is the best first step when you're looking to get into real estate investing. Big difference between residential and commercial real estate investing. Residential is 1 to 4 units. So they can be considered duplexes, triplexes, and 4-unit multifamily buildings, which is also referred to as a fourplex. 5 units and more would be considered a commercial multifamily building. So there's a big difference in terms of appraising the property, which means valuing the property, and also getting a financial loan on the property, which comes into effect on the amount of money that you can leverage. Bigger deals, generally commercial loans, 5 units and above, or like a gas station or a restaurant building or something like that, would generally require really 25% or more, generally 30 or 40% as the down payment. While residential, you could potentially put as little as 3.5% down. Let me explain how you would do that. Residential loans would be very similar to getting a loan on a single family home, which is just one house, right? Your kind of traditional nucleus family home with the white picket fence would be called a single family home. Those could potentially be good investments, but they're also the most versatile and risky and volatile because if the market corrects, most of that value is based on emotion, right? How much does the market and different buyers value the house and the location? That can fluctuate because it's not really set on much. They kind of set the appraisal on the last 6 months' sales, but if that's fluctuating, just give it a couple months and it could really drop in value. Why a 2 to 4 unit building could actually be locked in, and it's much harder to lose value because it's more based on the lease income. And what the bank does is the bank, when they come in and say, hey, we're going to give you a loan, and you tell your mortgage broker, I recommend a mortgage broker, I'll do another video on that, over a loan officer, which would be like your person at your local Chase branch or Bank of America. But when they do the loan on a 2 to 4 unit building, they're going to take your debt to income ratio, which is basically your income, what's on your tax statement as your income for the last year or two, compared to your debts, your rent, your expenses, student loans, anything else you have. They'll kind of compare those two numbers and call it your debt to income ratio. And they want to see a fairly high income ratio to make sure that you can afford to pay the loan. When you get a multifamily building, they count the additional property. So basically, if you're buying a 4-unit building, they'll count the other 3 units rents towards your overall income, which is a really big thing in qualifying. Um, Now, if there are leases already, let's say you're buying a 4 unit building, it's kind of old, it's been around for 10, 20 years, but it has tenants already in place and they're paying decent rents. You can take those leases, the bank will look at the leases and say, okay, this guy's paying 1,500, this one's paying 2,000, and this other one's paying 2,200. Count all those and then basically count the empty unit as the one that you'll live in because it will be a primary residence. Now, if you're not going to buy it as a primary residence, you have to put up a little bit more money. The bank's going to want to see, the lowest I've seen is like 10%, but normally you're going to want to do like 20 to 25 to get the best rates and not have private interest insurance, which is just an extra fee that has to be paid with the mortgage. You may have to do that on an FHA loan with a little amount down. There's also some banks that will do it with a lower amount when it's your primary residence. So if you're going to live in one of the units and then you're going to have 3 more paying, you're either going to pay a very small amount of that overall mortgage and taxes and all the expenses for the building, or in a lot of cases, if you're smart and you find the right deal, you can actually live there basically for free. And I know people that actually make money every month but still have a place to live. I recommend this for everyone. I tell every one of my clients, even though they want to buy homes as their first home, or a condo even, I would say, look, consider multifamily because it's going to be much better off. Why? Let's imagine you buy a multifamily building, you live in one of the units for 3 years, okay? You save up, your career starts taking off, and then you move out and go find a house that you really like. Let's say you got married, you want to have a kid, you guys go off and get a house. Well, those 3 years while you're living in that building, you're probably increasing the rents every year 3, 4, 5%, depending on your area, which means every time you increase it, your bank appraised value goes up. Maybe the market's been pretty decent and some recent sales around you have also gone up. You can use that equity in the property towards the next property you purchase. So it's this amount of equity buildup that I think is a really great potential. All you have to do is buy the multifamily building, make sure that you can manage the rental properties and collect the rent on time, handle it where you have a good deal where the rents are profitable on day one, even after all your expenses, including your interest, your mortgage, everything like that. And then all you have to do is wait and continue being there because you're going to build value over time through the increase of rents, through the appreciation of the general area, or at the very least, just from paying down your amortized mortgage. So eventually you can then leverage that equity buildup that you get and then purchase a second property. And this is really the way to build wealth. Now, obviously, when you do this a couple times, you're going to have some serious equity built up, and you can talk about 1031 exchanges into a much larger apartment building like Robert Kiyosaki's recommending. But from a first purchase standpoint, let's say you could do it for as little as $20,000 in some markets. In LA, to buy a decent property that you really want to live in, you could do it for as little as $30,000 or $40,000 if you're smart, as long as you have documented income and you can qualify for the loan. So this is my recommendation: is buy a multifamily building, live in one of the units for a bit, make sure the rents cover all your expenses, hopefully plus some, increase them year after year to get really good tenants in place, and then use that leverage to either purchase another investment property or to upgrade your own lifestyle, which I actually think you should hold off for a little bit until you really have passive income coming in with your investments. But this is just my tip on how to get into real estate investing, not only for your personal life, but to build wealth, and how to eventually get to that level of owning a large apartment building. It's all about leveraging your down payment through financing and buying a smart investment that has the highest chance of appreciating and gaining value and building equity for you. And I think a 2 to 4 unit building is the best way to do it. If you're in LA and you're looking for a building like this, we have plenty of the best deals on our website at wearerealty.com.